delighted to welcome our next speaker to the stage. Avi Gilbert is an Elliott Wave market analyst and author of ElliottWaveTrader.net, a live trading room featuring analysis by him and a dynamic community of professional traders. Mr. Gilbert's Elliott Wave analysis appears frequently on sites such as TheStreet.com, MarketWatch, Forbes, and Seeking Alpha. Avi, the stage is yours.
Thank you so much. Good evening, everybody, and thank you so much for joining us. I'm going to go through a general view I have of the market on a number of time frames. And I'm going to give you a little bit of info about what Elliott Wave analysis is and what I do. And I'm going to leave probably I'm hoping to leave at least 15 minutes at the end of the presentation for questions, because a lot of the good information actually comes through when you guys ask questions. It brings out information that I didn't address. But I'm going to request that you guys post your questions specifically on the S&P 500 and the analysis that I'm doing here, rather than going off on tangents of gold, the dollar, bonds, what have you, individual stocks. Let's try and keep it to the overall equity market for now, and let's see how those questions come out. But in the meantime, let's get started. My name is Avi Gilbert, and as Jordan said, I am an Elliottician. Well, what does that mean? Well, many moons ago, almost 100 years ago, actually, about 90 years ago, there was a gentleman named Ralph Nelson Elliott. And he was doing some market analysis, and he discovered a number of things that are quite helpful to us today. What he identified was that the market was fractal in nature. Well, what does that mean? Well, it means that the market is variably self-similar at all different degrees of trend. Now, let me explain what that really means in English, as they say. Elliott believed that the market moved in a 5-wave trend. Waves 1, 3, and 5 move with the trend, and wave 2 and 4 are counter trend corrective pullbacks. Now, within each of the initial waves 1, 3, and 5, they themselves break down further into 5-wave structures, and so on and so forth. And you can keep going down to smaller degrees. You can go start at the monthly, you could take it down to an annual, you could take it down to a day, to a 60-minute, and it's all going to apply in the exact same way. And that's why it says they're variably self-similar at all different degrees of trend. So if I'm looking at waves 1, 3, and 5 on any chart, they will be comprised of 5-wave structures. If I look at waves 2 and 4, they will be comprised of 3-wave structures. 3 waves is corrected. 5 waves is what I consider impulsive. So Elliott identified that the market is fractal in nature, and what really drives the market is what really is so interesting, and so many have a problem grasping. What Elliott discovered was the market represents social mood of the public, of society, and that society's mood is actually patterned, and it moves within this structure. When he applied Fibonacci mathematics to it, it made it much more powerful. Why Fibonacci mathematics? Well, for those of you that understand what Fibonacci mathematics really is, it centers around what they call the golden mean. And if you look throughout all of nature, most of the ratios you see throughout all of nature actually are built upon the golden mean. What is really most interesting is that we've had a significant amount of behavioral studies being conducted with the market and individuals. And what these behavioral studies have shown was that human decision-making actually revolves around that same proportion within the golden mean. We've had studies that have shown individuals will separate various items that they're asked, that they're completely uninterested in, and they're asked to separate those items into however they think it looks best or seems appropriate, and they actually divide it based upon the golden mean. When we look at mass sentiment, there have been many studies that show that the markets and people's mass sentiment moves within the golden mean. Most people will utilize 618 retracements or 0.382 retracements, and that's pretty common among technicians. The question is, how do you use it in an appropriate fashion? Because most of the people that I see that apply these Fibonacci ratios don't do it in an appropriate context. So what Elliott showed us was not only was the market patterned, was it fractal, and did it represent society's social mood? He also showed us that it moves within a certain rhythm. And that rhythm is what we're actually trying to analyze as we look at the market. Now, I have up on the chart right now a very long-term chart of the S&P 500. And if you could start, I mean, you could take a look, let's say in the early 30s, and you'll see the Roman numeral wave 1 in parenthesis right before the Wall Street crash. So we look at that along this long-term account, that was the top of a wave 1. Now, as you could see, we got 5 waves moving up into that. Wave 2, back at that time, was the Wall Street crash of 1929, and it led us into the Great Depression. Now, if you see that crash, really, that wave 2 only lasted a couple of years. It was not very long. It was a very, very rapid decline, and it gave us our wave 2 correction rather quickly. And then it set us up for this multi-decade bull market. Now, I'm going to tell you something that still blows my mind. Back, I think it was around 1941, Elliott put out a public post, a public proclamation, whatever you want to call it, where he proclaimed the market was about to enter into a 70 or 80-year bull market. Now, I want you to consider the times that he was saying this. Elliott was saying this in the heart of World War II. World War II was raging around him. And Elliott came out and said, okay, great. I'm seeing now the opportunity. We're going to have a 70 or 80-year bull market. Now, ladies and gentlemen, to me, that was probably the best market call of all time, because no question about it, he absolutely nailed it. Now, as we're looking at that rally that Elliott called for, I want you to take a look at where Roman numeral 3 is at the top of the chart. See, we had wave 1, then we had wave 2 pull back into the Great Depression, and then we have this multi-decade bull market that's about to top out for the same Roman numeral wave degree of wave 3. Now, if you take that wave 3 apart, you'll see it also subdivides into a 5-wave structure. Wave 3 of that structure topped out, I think it was 2000. And that's when we had the dot-com top, dot-com bubble. And we rallied again into the 2007 housing bubble. And then we had our massive drop in 2008 into 2000, early 2009. And as you can see, that was what we called, we classified that as Roman numeral 3 and Roman numeral 4. We topped at Roman numeral 3 at the dot-com bubble. And then we had basically it was a 10-year sideways move for wave 4. And as you could see, it was labeled ABC, 3-wave correction. And right now, we are in the process of completing the final 5th wave within that larger degree wave 3 in paren that is related to, we're topping out from wave 3 after we completed wave 2 going into the Great Depression. So my analysis suggests that as we complete this wave 3 over the next 2 years, and I'll start going into it in the smaller degree, we'll move to a monthly chart next. I just wanted to give you the bigger picture of how I'm seeing this. As we move into this, my expectation is over the next 2 years, I intend we're going to be striking a major top. Now, if you look at the wave 4 in paren, you will see, again, ABC, and I think we're going to go relatively sideways. Now, if you look at wave 2 again, wave 2 was straight down. Elliott gave us something called the theory of alternation. The theory of alternation suggests that if wave 2 is basically straight down and fast, wave 4 is probably going to be very, very sideways, and it's going to be very, very long. It will alternate in the manner in which it takes shape relative to wave 2. So our expectation is the next major bear market can take us quite some time. In fact, there is potential it could take us 20 years. And that's what you're seeing on here. So if you're looking at this, yes, my expectation at this point in time is for a 20-year bear market. Well, let's move into where we are in the structure. Now, this, I want to just show you. Hold on a second. Let me go back here. You see this wave 4 here, where we start the end of the Great Recession, 2008, 2009, that Roman numeral wave 4. Well, that Roman numeral wave 4 relates to, let me get my charts up. There we go. That Roman numeral wave 4 relates to this wave 4 down here in 2009. So I'm now tracking that final 5th wave. Remember, we're 5 waves. A 5th wave is subdivided into 5 waves itself. So I'm now tracking this 5 waves off the 2009 low. And as you can see, 1, 2, 3, 4, and now we're in the 5th wave. Now, for those of you that thought that the March 2020 meltdown was the shortest bear market of all time, I'm going to tell you that's really not the case. We actually topped in this wave 3 off of this low earlier in 2018. And this entire, even though it made a higher high, and yes, corrections can't even make higher highs, believe it or not. We've seen it throughout market history. So this rally was actually a B wave within this ABC wave 4 structure. So this correction actually took approximately 2 years and not just 1 month that everybody thought. And that's why everybody was so surprised that we rallied right out of that. Well, if any of you had read my analysis at the time, we were calling for a low at 2,200 on the S&P 500. And the reason is it represented an ideal point of confluence where a number of calculations met, along with being the 0.382 retracement of wave 3. I'm not going to bore you with all the technical jargon and how we calculated it, but our expectation was the market was going to bottom at the 2,200 region and then begin a rally that was going to take us at least to 4,000, but more with an ideal target of 6,000. And when we wrote about that as we were approaching the bottom, everybody thought we were crazy. There's just no way. And the rally starts and everybody's waiting for the next shoe to drop. We weren't, because our view, our context for the market told us that was the end of the correction and we're ready to roll again. And that's one of the things that Elliott wave gives to us that I really haven't seen from any other methodology that I've ever learned. And it gives us market context. And that's why I was able to say in March of 2020, get ready, we're going to 4,000 plus, and everybody thought I was crazy. Well, the market context that Elliott Wave gave us made it quite clear what the market was doing and where we were heading. Right now, as you can see, I'm trying to track from the bottom of this 4th wave, I'm trying to track the final 5th wave up into this high. And as you can see, we still have some to go. There's still some room to go, and I think it'll probably take us, maybe depending on how long this wave 4 pullback takes, it could take us into the end of 2023. It could push it into 2024. I'm really not certain on the timing specifics of it. Let me go into the daily chart and I'll show you a little bit closer about where I think we are. Now, I'm going to show you something. I'm going to take you back a little bit just to show you how we look at things. I did one of these, I did one of these presentations a while back, and I pulled one of the charts that I was using at the time. And if you note, at the time, I was looking for the market to pull back. My ideal target was about 4270 or so on the S&P 500. I was looking for another pullback, and then I was looking for a rally with an ideal target at 4882. And from 48.82, I thought we were going to come right back into this region for a wave 4, and then we were going to take off in our 5th wave. Well, let's see how that looks on the chart. Well, if you look at this, this was the rally that I was looking for. First of all, this pullback down to 42.70. That's really what we got. You know, I could take a look at it on the 60-minute chart so you could see a little better also. Here, this is probably a little easier for you to see it. Remember, if you saw that B wave rally, and then I said we're going to come back to the 42.70 region. And from there, I thought we were going to rally to 48.80. At the end of the day, we came up, you know, we bottomed at 42.70, especially in the futures. This came up maybe 10 points short on S&P because the futures hit it pre-market. And then our top from here came up about 60 points short of my ideal target. But take note, from there, we came right back into this region for our 4th wave, and that is what we are completing right now. Let me go back to the daily chart and give you a better look. And that's what we're completing right now. I believe we are completing this 4th wave within this wave 3 off the March low. So my expectation for 2022 is actually pretty simple. My expectation is I'm looking for the market to actually bottom out somewhere. It looks like we'll potentially bottom out at the bottom of our major market pivot. And from there, I think we're probably going to see a very strong rally begin. That'll probably take us right back up towards the highs. It'll probably take us, like I said, maybe 4,700 to 4,800 or so is where I'd like to see us. So I'd like to see us bottoming, you know, maybe around the 4,100 region over the next week or two. And from there, my expectation is to rally back to the highs, get another pullback in wave 2, and then off and running to 5,500. And that's the setup that we're seeing. And I have to tell you, the manner in which the market has been moving through our progression, something we call Fibonacci pinball. The manner in which this market has been moving since the March bottom has been almost perfectly textbook. Off the low, we had, remember, wave 1 is going to be 5 waves itself. That 5-wave structure exhibited an almost perfect Fibonacci pinball structure internally, where the waves had certain relationships with each other based upon Fibonacci mathematics, and they hit them almost perfectly off the low. The only thing that was not perfect was that this wave 2 was much more shallow than what we normally see during a 5-wave structure. Normally, you see a wave 2 pullback minimally to the 0.382 retracement of the prior wave 1. Oftentimes, it can go as deep as the 618. It can go as deep as the 618 retracement. Here, in the fall, we only pulled back to the 236 retracement, and that just set us up to melt up. And for those of you that were reading my articles at the time, as we were moving into 2021, I was looking for a major market melt up. And when we came into 2021, we were at about 3750, and I said my ideal target is going to take us first to the 4,440 to 4,600 region. And that was right here. We topped at 4,454. I said, we're going to come back and we're going to pull back to 4,270. And then we're going to rally up towards that 4,900 mark, the 4,882, which we came up 60 points short of. Now, why did I have these expectations that followed through so well? Well, what our Fibonacci pinball structure tells us is that when you have your initial 1-2 structure in place, your wave 3 of 3, I'm sorry, this way, I'm just going to do this degree. The wave 3 of wave 3 will often target your 1.0 to 1236 extension. So you'll target this region for your wave 3 of 3. You'll then pull back into the 618 to 764 extension, which is what we call our major market pivot. Normally, when the market moves through this pivot and comes into the 1.0 to 1.236 extensions, it then pulls right back to the 618 to 764 extension. That is exactly what we are doing right now. Now, at the same time, I want you to take a look at how oversold this market is. We are not as oversold as the March 2020 low. That was a record level of being oversold. But if you look at prior instances of significant market sell-offs, you will see back here at the end of 2018, you will see we came down right back down to the support region that I see the MACD normally take us to. When we pulled back to this point, it set us up for over 1,000-point rally off there. We are now at the same level of being oversold on the S&P 500. What is even more interesting is if you look at the NASDAQ, especially the NASDAQ futures, the NASDAQ futures are now hitting the same level of oversold that was struck in March of 2020. And what happened after March of 2020? We rallied like a bat out of hell and we did not stop. Ladies and gentlemen, that is what I'm expecting here. Once we complete this downside structure that we are in the midst of, and I think it can complete within the next week or two, I think you're going to see the market turn up and turn up very strongly. And I think it can definitely support another 1,000-point rally. Now, if you notice where we are right now we're at 4,300. Even if we go to 4,100, my expectation is we're going to 5,500. The technicals have reset and the bearishness in the market has reset to the extent that it can now support a rally towards 5,500. And that is exactly what these fourth waves tend to do. They tend to reset sentiment. As the market pulls back, sentiment gets extremely negative. And what you do need is that extreme negative sentiment to now act as your contrarian signal for the market to be heading up in the opposite direction in a very strong way. And the same thing happens at market highs. When you get too bullish and the sentiment is too extreme on the bullish end, that's how you top. That's the simple nature of the market, ladies and gentlemen. The simple nature of the market tells us when you get too bullish, nobody else to buy, market moves in the other direction. When you get too bearish and there's nobody else left that's going to sell, well, at that point in time, market's going to move in the other direction. And based upon the extreme nature of being oversold that we're seeing on so many different charts, I think the reversal is going to be quite strong. So if you watch these daily charts, most of the people out there are probably just regular investors. You're not day traders and you're not doing small term trades. I know we have about 8,000 members on our services, and about 70% of them are just long-term investors, and maybe 30% of them are short-term traders, but 70% of them are long-term investors. And if you're a long-term investor, you're looking at this daily chart. And what I'm going to suggest to you is allow them, this is a great buying opportunity. And once you allow the market to bottom out and turn right back up, once you see that MACD turn positive again, that is probably going to give you a very strong indication that we are absolutely ready now to be heading to 5,500. You will likely still see this wave 2 retracement after we complete a rally back up to the highs. You'll see that wave 2 retracement. I don't know how deep it's going to be just yet, but the way I'm showing it right now, this posture that I'm showing, it's not terribly deep, and I don't think it's going to be terribly deep because it has to project up towards the 5,500 region. Now, when we do our analysis, it's not that I'm just slapping numbers onto a chart and letters onto a chart. If you actually follow the manner in which we do this analysis, every single wave within this structure has been gone through with a fine-tooth comb, and everything aligns at every degree of wave. So when we learned from Elliott that the market is fractal in nature, in order to come up with a really high quality Elliott wave analysis, we need to have all our I's dotted and all our T's crossed, meaning each and every one of these wave labels has been perfectly in alignment with lower wave degrees and higher wave degrees. That's why I'm saying I think we're going to go back up towards the highs to create this 1-2 structure, because that will give us an appropriate Fibonacci extension projection based upon our standards that point us right to 5,500. So in a very, very simple way, I will just explain, and then I could start taking questions pretty early. I will simply explain that I'm looking for this pullback to probably complete over the next week or two is my guesstimate. And from there, once you see us rallying back up towards the highs again, the next pullback will probably be your last opportunity to start buying for the rally that I expect to 5,500. And you know, the reason I have this expectation is because this chart has been money for many, many, many years. It has given us turns almost to the penny. For example, you know, my target on the wave 4 pullback that we got in March 2020 was 2,200. I think we bottomed at 2187 or 2188. I think I was off by about 12 or 13 points. But throughout this entire progression, every single target has been just about hit. I think our biggest miss was that we missed by that 60 points off of that 48.82, and we only came up to about 48.20 or so. I think that may have been our biggest miss so far. So that 60 points was our biggest miss when you consider that that rally that we were expecting was approximately 600 points from 42.70 to 48.82, 610. We got about 550 of it out of that 610. So for now, I think we've been handling this pretty well. My expectation is for this to continue to follow the chart as it's been laid out for us for quite some time. So I think I can stop here and start taking some questions.
Excellent presentation, Avi. Can you hear me okay?
I can hear you.
Fantastic. Well, we've got a lot of questions. So let's see
Sure.
here. Well, so we've covered what will drive the market up. What is the you kind of cover this too, but what is the S&P going to do in the next 30 days? I think you've kind of highlighted that. Is there anything else you would want to touch there?
No, like I said, I think we can push lower one more time, but I'm not expecting too much more. I'm looking for maybe one more spike down to 4,100, maybe even slightly below it, and then a very strong reversal.
Okay, excellent. Our next question is: was the recent decline in the markets the mini crash, mini crash, or correction you were expecting came earlier, or is it still to come in February?
No, it came a little bit earlier than I expected, but it's basically along the same lines of what we were expecting. You know, whenever you get a C wave down within a wave 4, those are why you call them mini crashes. I'll tell you, this wave 4 here, guys, into the March bottom, that was a C wave. So, you know, these C waves are what really changes, you know, everybody's outlook on the market. The C waves exhibit a significant amount of bearishness, and that's really what allows you to then bottom and turn back in the other direction really strongly. We are now involved in a C wave, and we're trying to complete that C wave. And as you can see, everybody is quite bearish around us. I mean, I'm hearing talk of, you know, we're going down to 3,500, we're going down to 3,000. I mean, I'm hearing some crazy stuff. But, you know, right now, my expectation is I think we should be bottoming soon. And then I think we're going to be turning up quite strongly in the first quarter. And by the end of the first quarter, I think we're going to be all set up to rally to that 1618 extension in the 5,500 region, probably hit it around the end of 2022 into early 2023. But I think the first quarter we'll see bottoming and then a rally to set up the major next bull market phase that I'm expecting into the end of this year.
Excellent. Our question for you next is: does wave 5 of 3 not happen if SPX breaks down below 4,000 in this counter trend pullback?
Well, I mean, between me and you, we can get down even to the 3,700 region and still head up to the 5,500 region. Not my expectation, but it is still it's within the realm of possibilities. I don't think it's highly probable. I think what is more probable is we will probably bottom out soon somewhere at the bottom of our market pivot.
Thank you. Our next question is: what percentage of the time does Fibonacci pinball method correctly predict target prices?
That is a very good question. When you're involved in waves 1, 3, and 5, I mean, it is like printing money trading it. The problem comes into corrective waves 2 and 4. Elliott explained to us that waves 2 and 4 are the most variable structures within the market. So when you have corrective structures, you often get a lot of whipsaw. And that's what we're seeing right now. In fact, a C wave, which is what we're in right now to complete this ABC wave 4, a C wave takes shape as 5 waves. And I'll show you guys this here. Let me show you this on the 60-minute chart. So we're in a C wave right now. And if you see all of this, this mess, well, that traditionally signifies a wave 4. So within a wave 4, it is a very variable structure. So within a wave 4, we still have caught most of these up and down movements within this wave 4, even though it's been so variable, we still have caught them with our Fibonacci pinball structures. But it is much more complex within 4s and 2s as opposed to 1, 3, and 5.
Excellent. Let's see. How do you explain the difference in your interpretations of EWT?
Well, that's where we came in with Fibonacci pinball. Fibonacci pinball has been the absolute game changer when it comes to Elliott wave analysis. The biggest complaint that people have about Elliott wave analysis is that it is too subjective. And, oftentimes you'll see people slapping, putting on numbers and letters onto a chart, and it supports their perspective. But that's the problem. Most people will use Elliott wave to support their perspective, not to come up with an objective perspective. So what we've done is we've created something called Fibonacci pinball, and it puts basically an objective box around the Elliott wave analysis. And it gives us a very objective manner in which to look at the market. It tells us, are we going to continue in this progression that we're tracking, or are we going to get an early signal that this is going to break down and we have to change around very quickly? And again, that is what Fibonacci pinball does for us that no other Elliottian is able to do. It provides an objective framework, and we are very happy to teach it to anybody who's willing to learn. We've taught 8,000 people, if not more by now, but Fibonacci pinball is really the game changer in Elliott wave analysis. Did I lose you guys?
Avi, can you hear me now? I was just talking to myself. I apologize.
Yeah.
Excellent response there. So our next question is there any sectors you would emphasize on this next move up? If you want to answer that, or we can.
Yeah, I'm not going to go into sectors right now because that's going to take us down a rabbit hole. So I'm going to leave that alone for now.
Okay, excellent. I've seen some timing cycle work that has had since early November that has waved down, was due to end and near wave February 2nd 4. It sounds like your work is now converging around that same time as well. So essentially they're saying, are you looking for the wave down around early February as well?
Like I said, I think over the next week or two, I think it's feasible to get a bottom to this pullback already over the next week or two.
Okay, let's see here. Do you think we're going to stay away from leverage ETFs? Let's see here. Okay. So how do you calculate your FIB points? Can you give a specific example?
Sure. Wave 3, once you have the first wave and second wave in place, you can now calculate your entire 5-wave structure rather clearly. Wave 3 of 3 will often target the 1.0 to the 1236 extension. Wave 4 of 3 will pull back to the 0.618 to 0.764 extension. And then wave 5 of 3, if it's short, it takes you to the 1382. Normally, wave 5 of 3 will take you to the 1618 extension of waves 1 and 2. Wave 4 will then take you back to the 1.0 extension of waves 1 and 2. And then wave 5 takes you up usually to the 1764 to the 2.0 extension. And I'll even take you through that right here. Like I said, you have wave 1 and 2 off the March low. Wave 3 of 3 took you right into the middle of the 1.0 to the 1236 extension. We're coming back now into the 618 to the 764 extension in wave 4. And now wave 5 of 3 to finish off wave 3, my expectation is the 1618 extension, which is in the 5500 region. After that completes, I'm looking for an almost 20% pullback for wave 4, which takes you to the 1.0 extension of waves 1 and 2. And from there, we go up to the 1764 to the 2.0 extension for wave 5. That's the general gist of Fibonacci pinball.
Excellent. Excellent. I just want to make sure I wasn't on mute there. All right. So our next question is, Avi, in this current correction, what level would the S&P need to break for you to say that the count is incorrect and that January 22 4800 level top was the top?
I'll be honest with you. I see that this top as being the top is probably less than 10%. I'm just going to say it like that. The chances that this top has been the top. Now, I could say the next high we hit, when we go to 5500, that there is potential for that to complete the entire rally. And for that reason, I've already told all my members that my intention is I'm probably going to go to about 70 or 80% cash once we get to that high. Because if I am right, well, then I'll get a 20% pullback, I'll get a 20% sale, and I can put money back to work for the next rally. If I'm wrong, well, I've already gotten all my money. And if I'm wrong and we break down that support, well, then off we go into a potential multi-decade bear market. So right now, I see the potential that this is going to end this entire rally. I see that potential is probably less than 10%. So it really isn't a big concern that I have right now, especially when I'm looking at just how oversold we are. We are now set up for a 1,000-point rally. I can't say I see anything that is strongly indicative that this is going to be a major top. Not yet. Not yet.
Excellent. Our next question is, does Elliott theory work for individual stocks?
Absolutely. And that's an excellent question. I rail against using fundamentals when it comes to the market as a whole. And that is because when it comes to the market as a whole, fundamentals are often very, very lagging when it comes to the market. As an example, when we dropped down here, the bearishness that we had down here was absolutely extreme, and we were looking to turn up strongly. But the fundamentals were terrible. Not only were the fundamentals terrible, you were seeing economic lockdowns countrywide. You were seeing the worst of the COVID rates being hit. And you then also saw record unemployment. You know, one of my favorite, let me see if I could find it. I'm going to show you this. Let me pull this up. Let's see. Here we go. I'm going to show you this. This is one of my favorite pictures during that rally. The market was screaming higher. As it says, best week since 1938. And you now have the highest unemployment numbers in history. Do you know how long it took for the unemployment numbers to catch up? So, you know, you're often going to see the fundamentals lag when it comes to the market. Earnings did not start recovering until much higher. By the time that economists declared that we were no longer in a recession, we were already 1,500 points off the low. So when you deal with fundamentals, they're going to lag when it comes to the market. But when you're dealing with individual stocks, you have to look at it on a continuum. For example, if you're dealing with a major cap stock, a mega cap stock, that is going to be exactly like the market. The mass sentiment is what's going to control the movements of that stock. You would often see how they're going to miss earnings, and the market and the stock still goes higher. They're going to blow out earnings, and sometimes it comes down. When it comes to mega caps, sentiment and Elliott wave is really what you need to know. But when you move down that continuum to lower and lower and lower capitalized stocks, you go all, let's say you go all the way down to, a small micro biotech stock that has one product in the pipeline, Elliott wave is not going to be as helpful as understanding the fundamentals of that particular company. Elliott wave is not as helpful unless you have mass sentiment being represented. Mega caps, big markets, that displays mass sentiment. But as you move down that continuum, the lower you go on the continuum, the more fundamentals will play into how that stock will move. So if your question again is, does this work does Elliott wave work for individual stocks? Absolutely. It works better than fundamentals for a lot of these stocks. But like I said, when you start moving down the continuum, you better know your fundamentals.
Very well answered, of course. And we've got a time for a question or two left. Is your software automatically drawing Elliott waves, or do you have to specify what you consider top and bottom for it to draw them?
Oh, I wish I had an automated way to do this. Believe me. It's one of the things we have in the hopper is to program this based upon our perspectives of how to apply Elliott wave analysis. But we've been so busy, we just have not had an opportunity to get there. But no, I do all of this by hand.
Wow, that's a lot of work.
Yeah.
All right, let's see here. You mentioned NASDAQ 2 at the beginning. Is the S&P scenario more or less equivalent for the NASDAQ 2?
NASDAQ, I have some questions about whether or not the next rally can be all of its fifth wave. So that's why I'm going to go back and say, after the next big rally into the end of 2022 or early, maybe into the first quarter of 2023, my intention is to go significantly to cash, because there are some segments of the market that potentially will complete their major topping there.
Okay. Can Fibonacci pinball be applied to ETFs and options?
It absolutely, I apply it to ETFs all the time. How you apply it to options, options are just a manner in which you're going to enter into a specific investment. So I'm not so sure what you mean by when you're questioning, does it apply to options? I'm not sure I understand that question, but it absolutely applies to ETFs.
Excellent. Okay, I got a question or two left. Let's see here. Based on your chart, I see the possibility of entering a major correction by the end of this year. Did I read your chart correctly?
Well, that's what I have been saying. I'm looking for a rally up to 5,500, followed by what could be a 20% correction, 15 to 20% correction. So yeah, once the next rally completes, I'm looking to come back to 4,600.
Excellent. All right, this is a great, I think a great question for the final of the event here. Douglas writes in, when you say that 5,500 could be the top, is that because you have an alternate Elliott wave count, or because a fifth wave failure is possible?
Well, it's because I guess I'm a little more conservative than most. When I start buying into a pullback, like I said, I'm going to go back here and I'll show you, use this as an example. When you start coming down into what you believe is to the bottom of the third wave of the C wave, I will start buying my initial positions that I want for the next rally at the bottom of the third wave, because sometimes the market doesn't give us the full 4-5 and it truncates here. So I start buying as a habit, this is part of my own trading plan. I will start buying at the bottom of the third of the C wave, because sometimes the market doesn't always give us that final move. And I do the same thing on the upside. Oops, sorry. Do the same. Let me go back a second. And I do the same thing on the upside. So when we get to the top of that third wave, I'm just doing my standard trading plan. And that is, once we get to the top of the third, I will start exiting most of my positions, because you know what? Once you start getting up into this zone, there is potential that you could be wrong, and that is all you're going to get on that rally. I don't want to be a bag holder. I can always get back in lower, but that is just what experience has taught me for my own trading and investment plan.
Excellent. Well, that is all the time we have for today. Avi, it's a real pleasure. You've been a long-standing partner and speaker of the Money Show events, and by the questions here, I know our audience really appreciates it. So thank you so much for your time and your insights on the markets. We look forward to seeing you at the next Future Money Show.
Thank you very much for having me.
Have a great night.